On April 9, 2025, the United States stock market exploded. The Dow surged nearly 3,000 points in a single day, marking its largest gain since the start of the 2020 pandemic. This rally followed a sudden reversal in trade policy. The president had just used a post on social media to abruptly pause a global trade war that was barely a week old. The chaos began exactly 7 days earlier. On a day the administration called Liberation Day, the president invoked emergency powers to launch a massive tariff offensive on the global economy. The scale was unprecedented. China faced a 245% rate, the European Union saw 20%, and a 10% baseline hit nearly every other country on Earth. Global markets immediately rejected the move. In just 2 days, the Dow lost 4,000 points, and $6.6 trillion in global wealth simply vanished. Despite the record-breaking losses, the White House held firm. The president even claimed the crash was a deliberate attempt to force the Federal Reserve into lowering interest rates. If a $6.6 trillion stock market crash wasn't enough to stop the trade war, something else had to. To find the source of the administration's sudden panic, we have to look past the stock market and into the foundational mechanics of the U.S. bond market. In a typical crash, investors follow a specific playbook. They sell off risky stocks and move capital into the safe haven of United States government bonds. As demand for bonds rises, the interest rates tied to them, the yields, automatically drop. The administration initially celebrated this shift. They pointed to falling yields as evidence that their tariffs were actually lowering the cost of borrowing for American families and businesses. The White House mistook this initial dip for success, unaware that investors were actually preparing to dump American debt on a global scale. On April 7, that safety broke. Instead of buying U.S. debt to hide from the crash, investors began dumping bonds while also selling stocks. Trust was the deciding factor. Foreign investors, who own a third of all U.S. treasuries, saw the tariffs as a direct threat to American fiscal stability and fled for the exits. As bond prices fell, yields, the interest the government pays, rocketed upward. The 30-year yield saw its largest jump in over 40 years. This is bond vigilantism. It occurs when financial markets go on strike, using interest rates to challenge a government's agenda. The consequences are felt immediately. Spiking yields cause an instant surge in interest rates for home mortgages, for business loans, and government spending, threatening to bring the economy to a standstill. While a stock market crash hurts individual portfolios, a bond market crisis can paralyze the underlying mechanics of the entire United States economy. This reality triggered a panic inside the West Wing. The Treasury Secretary, Scott Bessent, rushed to the president with a warning. The bond market was entering a state of total collapse. The administration surrendered immediately. Bowing to the pressure of the bond vigilantes, the president hit pause on the tariff increases to stop the bleeding in the debt markets. The chaotic retreat led to immediate calls for investigations. Lawmakers questioned the timing of the president's social media posts, which urged his followers to buy just hours before the market-saving pause was announced. By May, the stock market had recovered its losses. The tariffs remained, but they were riddled with exemptions. By the end of the year, half of all imports were excluded from the new rates. The events of April 2025 demonstrated that a president can use emergency acts to start a trade war, but the bond market remains the final check on that power.